Hello, and welcome to Capitol Creek's 3 in 10 podcast. Today is June 13th, 2025. We're recording at 3:26 p.m. Central Time. I am your host, Scott Slayton, strategist and partner at Capitol Creek, a multifamily office in Austin, Texas. Here are the 3 things we think investors need to focus on and understand this week. Number 1, the inflation data. The data came in better than expected, continuing a trend of disinflation. Number 2, the initial public offering market is reviving, and we've got some interesting data to support that, and we'll talk about what that means. Number 3, the US dollar at fresh 3-year lows, despite a major uptick in geopolitical tensions with Israel striking Iran overnight. So let's start with number 1, the inflation data. The consumer price index for May came in better than expected on both the headline and the core measures, both rising 0.1%. The PPI, also for May, came in better, rising 0.1% on the headline, the core, and ex-trade. Continued good news on inflation is now a trend, in my opinion. The New York Fed's one-year inflation expectation fell from 3.6 to 3.2. And today, the UMich one-year inflation expectations fell sharply again for the second month in a row. So it looks like, at least from the survey data, that inflation expectations are well anchored. We continue to converge closer to the Fed's 2% target, with all of the inflation gauges that I'm watching. The highest is around 3, but most are below 3 and continuing to trend lower. Now, we anticipate some uptick in inflation in coming months due to the tariffs, but we do not expect a surge in inflation. It has been our long-held thesis that exporters or countries that send goods to the U.S. will eat about a third of the tariffs, that importers, companies that are importing these goods, will have to eat about a third. And consumers will also have to eat about a third. But do not believe those who tell you that the consumer is going to have to eat all of these tariffs. And also don't believe those who tell you that the export countries are going to eat all of these tariffs. Both are wrong. It's somewhere in the middle. But we don't think there's going to be enough of an inflationary impulse here in tariffs to cause a surge in inflation. And the trend is lower. And we think increasingly the Fed's going to look through this tariff-related noise. Also remember that tariffs will slow growth. These are tax increases. And that is going to make it harder for companies to simply pass the tariffs on to the consumer. The labor market is weakening. The economy is slowing. We think the Fed could cut in July as the labor market continues to weaken and the economy continues to slow. Now, the market is priced for about a 22% probability of the Fed cutting in July. We think it's higher than that. We think it's around 50%. And we still expect 3 cuts by the end of this year. If we don't get a cut in July, we think we'll get a cut in September, another one in October, and a final one in December. That sets up pretty well for the second half of the year for risk assets. Now let's go on to number 2 in the IPO market. This market is reviving, and it is happening here in 2025. We've waited years for this. Frankly, we did not understand why it did not happen sooner. But this is not just a U.S. revival. This is a global revival. I looked at the data on Bloomberg and really dug into it. And what I see here is that Asia, not North America or the U.S., being the deal leader, Asia is the deal leader with $25 billion raised. The U.S. is a very close number 2 with $23 billion raised. All these are 2025 data. The Asia IPOs have performed solidly, up 27% on average from the offering price. The U.S. IPOs have performed beautifully, up 53% on average from the offering price. The three C's I call CoreWeave, Circle, and Chime all raised around $1 billion very recently. CoreWeave back at the end of March, right before Liberation Day, but Circle very recently and Chime this week. CoreWeave and Circle are both up threefold from the offering prices. Spectacular performance. And Chime is up solidly from their offering Wednesday of this week. So we've waited years for this logjam to break. Real quality companies are coming public in the US and globally. I did also notice that Europe is the laggard here. Europe has only raised about $6 billion of IPO capital this year, but those deals have performed well, up about 35%. We also saw Voyager come public on Wednesday, raise $383 million. The stock is up 60% in 2 days from the offering price. So what does this all tell me? This tells me that liquidity is abundant, that risk-taking appetite has come roaring back from Liberation Day, and Liberation Day, at least for now, is a distant memory. It also tells me that we're early in a new bull market after a brief and devastating bear market in April caused by mostly tariff initiatives. The markets have gotten their footing. The earnings were fantastic. What I'm seeing is a lot of historical studies, whether it's breadth thrusts, where advancers outnumber decliners massively on big volume. We're seeing that. We're seeing 20-day highs above 65%, which is almost a surefire indication of a new bull market. We're seeing the S&P had that 9-day in a row rally. We've also seen a 3+% gain followed by 2 successive significant gains. That's another kickoff to a bull market. So technically, we're seeing a lot of signs that we're in a new equity bull market. I guess we'll see, because we're going to be tested in early July when the delay of the tariffs, the 90-day reprieve, unwinds in early July. I believe July 8th and 9th are the days when the tariff reprieve is over. We'll see. I expect that we'll probably kick that can down the road because a lot of deals are being negotiated right now, but that will be the next challenge, in my opinion. Now, our third thing for this week is the beleaguered US dollar. Yesterday, on Thursday, the 12th of June, the dollar basis the Bloomberg Dollar Index hit fresh 3-year lows. That's 3-year lows. That's a big statement. The 30-year bond auction yesterday was well bid and traded well, and yields continue to fall across the curve. The yield differential is compressing. That's bearish for the dollar. Trade war rumblings about July 9th as that creeps closer. Remember, tariffs are bearish the dollar for so many reasons, but I think we've seen that very clearly, that trade tariffs and trade noise is bearish the dollar. It's bearish dollar assets across the board, in my opinion. The trend in the dollar is lower, and it's become clear and persistent. Back in March, when I wrote that report, that long report, a deep dive on the dollar, it was unclear to me whether we were in a bear market for the dollar. I was anticipating one, but we had definitely not seen it in technical terms. Now we have, and making 3-year lows is very demonstrative that we are in a bear market. The Bloomberg Dollar Index is now down almost 9% since Inauguration Day. That is a really big move for the world's reserve currency in only about 140 days. I believe we're now about a third of the way through a secular dollar bear market. And I can see this bear taking the dollar down by about 1/3 over 2 years. I thought it was really interesting that the dollar could not rally really one bit on Israel's strike of Iran overnight. The dollar rallied so far today 20 basis points off a 3-year low when you have a major geopolitical event. This is abnormal. In my 35-year career, I don't remember ever having a geopolitical event of this size and magnitude where the dollar can't rally at all. it has historically been a safe haven asset that people flee to when there's geopolitical tension. Not this time. Gold, however, is up 1.5% today, and I believe has assumed the flight to safety mantle from the dollar that the dollar had for decades. I think gold is taking that mantle from the dollar. So there you have it, your 3 in 10 podcast. Please check out our website at capitalcreekpartners.com to view our written work, webinars, and interviews. And until next week, be careful out there, my friends.